Are you working towards financial independence? Thinking about investing your hard-earned money? Today I'm covering 7 critical investment mistakes that could be hindering your financial future. If you're aiming for financial independence, understanding these and how to sidestep them is crucial. I made several of these mistakes on my way to financial independence, but I was able to learn from my mistakes, course correct, and retire at 53. So let's get to it. The first mistake you are making, ignoring fees and expenses. A few things can eat into your profits, and fees and expenses are a large part of this. So you should always carefully review the fees of any investment products you're considering. And if you don't want to pay fees, you can consider lower cost index funds and ETFs. Managed funds have fees. Those managers have to get paid somehow. But not all fees are the same. I was always okay with a fee if it was less than 1%. Some investments may have lower fees the more money you have. We had several investments in our portfolio all under different accounts, and we managed to household all of our investments under one account, and this allowed us to get a lower fee for all of those investments. Just so you know, the fees can eat into your profits. The second mistake that you're making is not being tax efficient in your investments. Taxes can also eat into your profit. So to minimize this risk, you can use tax-efficient investment strategies such as maximizing contributions to your retirement accounts, your 401ks, your 403b, harvest tax losses. Harvesting tax losses means you sell something that is at a loss to try to balance any gains that you may have. And you always prioritize investments with a favorable tax treatment to minimize your tax liabilities and to maximize your after-tax returns. Now, let's get in a little bit deeper on capital gains tax. When you sell an investment for a profit, you may need to pay capital gains on those profits. Now, I'm not a tax advisor, and I'm only sharing my personal experiences with this. You need to be aware that if you have a higher salary and capital gains on top of that, you may be pushed into a higher tax bracket, which will increase your tax liability. Are you investing in an after-tax fund to bridge the gap between when you want to retire and retirement age? Make sure it is not a change-heavy fund. Now, what do I mean by change-heavy fund? Change-heavy fund, there's lots of moving around in the investment, lots of buying and selling. The managers are usually trying to rebalance the fund based on market conditions. But that manager doesn't know your particular situation. All that moving around may affect your earnings, and you may be paying more taxes on the capital gains. And those gains can put you into a higher tax bracket. One way of mitigating this, as I mentioned, was tax loss harvesting. You sell an investment that has lost money, and then you can subtract the losses from the gains come tax time. The third mistake is overlooking diversification. Are you putting all of your eggs in one basket? Lack of diversification can expose your investments to unnecessary risk. When most people think of diversification, they think, don't put all your money into one stock. But, diversification is much more nuanced than that. There are multiple ways to diversify. You can diversify across the asset class, stocks, bonds, cash, real estate, commodities. Within stocks, you can diversify across the sectors, tech, healthcare, consumer staples. And also you can diversify company sizes, large, mid, and small cap. Bonds also have similar ways to diversify if you're investing in bonds. There's also geographic diversification. You can invest in different geographic areas to mitigate risk with regional problems. Say there's a crisis in one part of the world, but if you have investments in another part of the world, that will mitigate that risk. You can diversify with the investment type, mutual funds, exchange-traded funds, individual stocks, bonds, real estate investment trusts. You can diversify the risk level. There's interest rate risk, credit risk, inflation risk, market risk. Once you come up with your diversification strategy, don't forget to review it and rebalance it to maintain that allocation and risk level that you want. As the market moves, your portfolio may become unbalanced. You just want to make sure you stay on top of that. The fourth mistake is chasing trends. Do you have FOMO in your investments, fear of missing out? Don't just seek out the latest investment trends or follow popular market trends. Don't buy whatever your friends are buying or your coworkers are buying. By chasing trends, you can seriously lose your money. How do you know if you're chasing trends? You're not doing your due diligence. You're failing to conduct a thorough research and analysis before investing. The herd mentality, following the crowd without questioning the underlying why. Why is everyone investing in this? Just because everyone else is? I don't know if you remember the Robinhood GameStop story from a few years ago. In 2021, individual investors drove a run-up on the price of stocks like GameStop and AMC. This trend gave rise to meme stocks. A meme stock is a stock that is, invested in purely based on social media speculation and trends. These trends often represent short-term market movements or speculative opportunities. This can lead to inconsistent returns and can actually undermine your long-term investment goals. These are usually highly volatile. Prices fluctuate wildly based on market sentiment instead of underlying fundamentals. Huge potential for losses. These hot tips tend to be short-lived and unsustainable. If you buy into the hype, you can lose a lot of money investing just because it's a current trend. To avoid the pitfalls of chasing hot tips and trends, you should stay informed, conduct thorough research, and avoid impulsive decisions. Another investment mistake is trying to time the market. You know the saying, buy low, sell high. This is super difficult to do. None of us know for sure what the market is going to do. By trying to time the market, you can miss opportunities and incur unnecessary transaction costs. So focus on a long-term investment strategy based on your financial goals and your risk tolerance. Everyone gets all excited when they look at the stock market and their investments are up. Look how much money I made. You haven't made any money until you sell it. The opposite is also true. If the market is down, you haven't lost money yet. You don't lose money until your investment is sold. When the stock market crashed in 2008, everything tanked and we entered a recession. Our strategy was to ride it out. Because the stock market was down, we thought we should increase the amount of money we're investing, add more money to our 401k, add more money to the amount we were investing each month. We had some friends who were so freaked out with the recession that they were going to pull all of their money out of their 401k when the market was way down. Don't do this. You should put more money in, not pull it out in the down market. That buy low, sell high thing. You don't want to be buying high and selling low. That's a sure way to lose your money. Timing the market is difficult and not advised, but don't pull your money out during a recession. There is a reason that those who stayed in the market after the great crash of 1929 became very rich afterwards. They stayed in, and when it recovered, and it always has to date, they turned those on-paper losses into gains. So my advice, if it is a down market, ride it out if you can, and the investment is still solid. The sixth mistake is not having a clear investment plan. Do you have a clear investment plan in place? What are your financial goals? Do you want to fund your children's education? Do you want to retire early, buy a home? You need to figure this out so you can make sure you're putting money into the right vehicles. Without goals, it's hard to measure the progress over time. How risk tolerant are you? How are you going to manage the risk? If you don't know this, you may take on more risk than you're comfortable with, or you can fail to protect your investments during downtimes. Another question you need to ask yourself, how are you going to allocate your assets? We've already talked about the need for diversification. How are you going to diversify? Before you start investing, you need to figure out your goals and come up with an investment strategy. Otherwise, you could just be spinning your wheels, missing opportunities, and losing money. So take the time to establish clear investment goals, risk tolerance, and a diversified portfolio strategy tailored to your financial situation and objectives. The final investment mistake that I want to talk about today is not using a financial planner. I know, because of the fees and other potential costs with using a financial planner, many people try to do this on their own. My wife and I used to do our own investing. This was back in the dot-com days, late 90s, early 2000s. Stocks were crazy. Companies found that if they just put an E for electronic in their names, their stock would soar. Statistics and fundamentals like market cap, P&E ratios, and actual revenue didn't matter. Those were heady days. People were making money left and right, including us. But then, everything crashed. People lost tons of money. We were okay. We picked a few stinkers, but we picked more winners that are still going strong today. But after the dot-com crash, we decided we needed help. We were tired of chasing trends. So we hired a financial planner who helps us align our investments with our goals. So get a good certified financial planner. Not only does he need to be a fiduciary that works for you, but he needs to align with your strategies. It is your money, and they are there for you. Always question their advice. If they want you to move money, ask why. Ask if they are getting commission to make the change. Find out if they are doing it for you or them. And yes, you can do it on your own. I know many people that do. Robinhood, Webull, those are all the rage today. But how much time do you want to take to learn the intricacies of investing? And who's going to help you align with your strategies? A good financial planner will help you define your investment plan, figure out your risk tolerance, and help you diversify your portfolio. If you get a good financial planner, you will have someone in your corner who will help you get to where you want to be. By taking a holistic approach, a financial planner can ensure that all aspects of your financial plan work together and support your long-term objectives. So there's my list of the 7 mistakes I wished I had known before I started investing. Avoiding these common investment mistakes can significantly improve your chances of achieving financial independence. Remember, the key to successful investment is not just selecting the right assets, but also effectively managing risks, expenses, and your overall financial strategy. Share your expenses or questions about investment mistakes in the comments. Until next time.